Welcome to Griffonomics.
Glad to be here for this one.
Yeah. I'm so glad you could join us today. For this deep dive, we're going to look at a company that you, the listener, probably interact with every single week without even realizing it.
Oh, absolutely. They are everywhere.
Right. We're talking about Cintas. And to really get into this, we've pulled together just a phenomenal stack of sources.
It's a heavy stack, too.
Very heavy. We've got their Q2 FY 2026 earnings transcripts, the Form 10Q, the raw SEC at each year financial data, and a series of really granular, independent investigative reports from Seeking Alpha.
Which is a fascinating stack of data, mostly because it paints a picture of a company operating at what looks like absolute peak performance. But there are some very complex mechanics running under the hood.
Right, and that's basically our mission for today's deep dive. We are going to explore Cintas's fundamental transformation, because they aren't just that company that drops off clean uniforms for mechanics or restaurant workers anymore.
Not at all.
They've evolved into this indispensable all-in-one facility services powerhouse. So we want to figure out the mechanics of their famous route density moat. We'll dig into their massive $5.5 billion acquisition of UniFirst.
That's a huge deal.
Enormous. And finally, we're going to try to solve a really interesting paradox. How can a flawlessly executing company be trading at a valuation so high that independent analysts are actually telling investors to stay away? Okay, let's unpack this, starting with the business model itself.
Which really is the engine driving every single thing else we're going to talk about today. It's an incredibly predictable machine.
Highly predictable. The numbers from the sources show that a staggering 95% of Cintas's revenue comes from recurring route servicing.
95%, that's incredible.
It's massive. And they basically have three main segments. You've
Right.
got uniform rental and facility services. That's the heavy hitter at 77% of total revenue.
Really?
Then you have first aid and safety services pulling in 12.2%. And finally, the all other category, which includes fire protection and direct sales, making up roughly 11%.
But you know, the secret sauce isn't just what they're selling. It's
Yeah.
how they're delivering it. That's the core of the whole operation. To understand why this model is essentially a cash machine, we have to look at that route density moat you mentioned.
Okay, break that down for us.
Right. So look at it through the lens of operating leverage. Think about the basic logistics. Sending a delivery truck to a specific zip code incurs a baseline fixed cost.
Right, you pay for the fuel.
Exactly. Fuel, the wear and tear on the vehicle, and obviously the driver's hourly wage just to get to that specific commercial office park.
So the truck is already sitting in the parking lot. The money to get there is spent.
The baseline cost is completely spent. Now, if you can get that exact same driver to drop off a clean batch of uniforms
Right.
and then walk over to restock the facility's first aid cabinet, and then inspect the fire extinguishers in the hallway, all at that exact same stop, the revenue for that single visit just skyrocketed.
But the incremental cost barely moved.
It barely moved well. That is massive operating leverage. And what's fascinating here is the role of the service sales representatives.
The SSRs.
Yes, the SSRs. These frontline employees aren't just truck drivers.
They're hybrid workers, really.
They really are. They are highly trained to build relationships because they're walking through the customer's facility every single week.
I see everything.
Exactly. They spot problems and they proactively cross-sell these additional services. And once a business is relying on Cintas for uniforms, first aid, restroom supplies, and fire safety, the switching costs become incredibly high.
It's just too sticky.
Way too sticky. It's operationally disruptive for a business manager to cancel Cintas and try to source 4 different local vendors just to replace them.
Okay, so the theory makes total sense. But are they actually winning new business with this? Or are they just squeezing more money out of the routes they already run? Because defending a moat with just human salesmanship, I mean, that seems tough to scale.
It is tough, which is why they're defending it aggressively with technology. They aren't just relying on handshakes.
Okay, what kind of tech?
Well, they use proprietary software called Smart Truck for route optimization.
Wow.
That dramatically cuts down on fuel and driver idle time. And they've also invested heavily in auto-sortation laundry facilities to handle the massive back-end volume.
Right.
But to your question about winning new business, they're using these high-tech solutions to specifically win over what they call no programmers.
Oh, right. Businesses that aren't currently using outsourced services at all.
Right. They aren't stealing customers from rivals. They're creating new ones. And they're targeting recession-resistant verticals to do it. Healthcare is a prime example.
Healthcare is huge for them now.
It represents a massive 8% of their total revenue. The investigative reports highlighted this brilliant case study where Cintas won over an entire 14-hospital network.
14 hospitals.
Yes. And they didn't do it by just offering cheaper uniforms. They did it by deploying automated scrub dispensing technology to solve the hospital's massive inventory loss problem.
I want to pause on that because it's such a great example of their strategy. For
Hmm.
you listening, hospitals lose an absolute fortune on scrubs.
Oh, yeah, they vanish.
Exactly. Nurses and staff hoard them, they accidentally take them home, they get thrown out. So Cintas comes in and installs what is essentially a high-tech vending machine for scrubs.
Right.
An employee swipes their ID badge, the machine dispenses a clean set of scrubs in their specific size, and here's the kicker. They can't get another set until they physically return the dirty ones into the machine's receiver.
It's brilliant. It completely eliminates the inventory shrinkage problem for the hospital administration. It saves them an absolute fortune.
But there is a catch.
Always a catch. The hospital is now totally locked into Cintas' ecosystem. Cintas owns the machines, they service the software, and of course they do all the back-end industrial laundry.
So they're selling technological inventory solutions that are just cleverly disguised as laundry services.
Precisely.
So if the technology is making these routes that efficient and locking in customers that tightly, how is that actually translating to the bottom line? Let's look at the actual Q2 FY 2026 numbers we have.
The numbers are staggering.
They really are. Total revenue came in at $2.80 billion, which is a solid 9.3% jump year over year. But the metric that really jumps off the page for me is their operating margin. It expanded to an all-time high of 23.4%.
Let's put that in perspective for a second. For a company managing physical logistics, fleets of diesel delivery trucks, and massive industrial laundry facilities.
Heavy physical infrastructure.
Right. A 23.4% operating margin is almost unheard of in the industrial sector. It speaks to the sheer power of that route density and cross-selling we just talked about.
It makes them a total cash machine. They generated $425 million in free cash flow in Q2 alone. That's up 23.8%.
A huge cash generation.
But here's where I need you to translate some of the corporate finance for us. Because they aren't just sitting on that cash. They're in the middle of a major buyback blitz. They executed their third largest quarterly buyback ever. They spent $622.5 million repurchasing their own stock.
Right.
Wait, they generated $425 million in cash, but bought back $622 million in stock. Where's the rest of that money coming from?
That is the million-dollar question, or I guess the $600 million question.
Yeah.
And it requires a deeper look at those investigative reports we pulled from Seeking Alpha.
Okay, what did they find?
To understand this aggressive capital return strategy, you have to analyze the compensation structure of the C-suite. Management's compensation is heavily tied to earnings per share, EPS growth.
So there's a massive personal financial incentive for the executives to keep that one specific metric climbing no matter what.
Heavily incentivized. And remember how EPS is calculated. It's the company's net income divided by the number of outstanding shares.
Right, basic math.
So you can boost EPS in two ways. You can organically grow the net income, which is hard work.
Slower work.
Or you can reduce the number of outstanding shares through buybacks. That artificially inflates the EPS number, even if the underlying business growth is just moderate.
But as we just said, they're spending more than you're making to do it.
They are. The independent reports point out that Cintas is utilizing short-term debt, specifically commercial paper, to help fund these stock buybacks at a premium.
Okay, for the non-finance folks listening, what does that actually mean in plain English? Think of it like taking out a massive credit card cash advance to buy your own company's stock just so your earnings per share looks higher on paper and you hit your year-end bonus targets.
Wow.
Yeah. It's a strategy that works brilliantly right now because the company is executing perfectly. Interest rates on commercial paper might be manageable and cash flow is abundant.
Sure.
But it carries real long-term risks if organic growth were to suddenly stall. You're essentially leveraging the balance sheet with short-term debt to maintain a growth narrative for Wall Street.
That's a huge piece of context to keep in mind, especially as we look at their latest massive strategic move.
Yeah.
Because they aren't just buying their own stock. Here's where it gets really interesting. In March 2026, Cintas announced a definitive merger agreement to swallow up their smaller rival, UniFirst.
Yeah.
It's a massive $5.5 billion consolidation of the North American uniform market.
It's a monumental deal. It fundamentally reshapes the entire competitive landscape.
It really does. Cintas is paying $310 per share for UniFirst. According to the analyst, that represents a massive 44 times historical PE premium.
44 times.
On the surface, paying that much of a premium for a smaller, slower-growing competitor seems wild. How do they justify a $5.5 billion price tag?
It all comes down to the synergy thesis. Breaking down the forensic accounting of this synergy gap is where the operational brilliance of the deal really emerges.
Okay, let's break it down.
Cintas management expects to capture $375 million in annual run rate operating cost synergies.
Yeah.
And they plan to do this within 4 years of closing the deal.
$375 million.
Every year. To understand how they plan to actually extract that much cash, you have to look at the concept of margin equalization.
Because right now, the profitability margins of these two companies are completely disconnected, right?
They're playing totally different games. If you look at the SEC EDGAR data, Cintas operates at an adjusted operating cash flow margin of around 24%. And they have that 23.4% operating margin we mentioned earlier.
Right.
If we look at EBITDA margins, Cintas is up in the 27% plus industry-leading range.
Wow. And UniFirst.
UniFirst, on the other hand, their operating margins are lagging way down in the 7 to 8% range. And their EBITDA margins are sitting around just 13%.
13% versus 27%. So Cintas is essentially looking at UniFirst and saying, you guys are leaving half the money on the table. We can run your exact same business twice as efficiently as you can.
That's the entire playbook right there. The core strategy is to aggressively pull UniFirst's lagging 13% EBITDA margins up towards Cintas's 27% level.
But how?
They plan to achieve this by combining route networks. Think back to our route density concept. If a Cintas truck and a UniFirst truck are currently driving down the exact same street to service two businesses next door to each other,
You just eliminate one of those trucks entirely.
exactly. You eliminate redundant laundry facilities, you migrate UniFirst's volume onto the superior tech-enabled Cintas platform. They're basically buying UniFirst's revenue base and applying their own hyper-efficient operational engine to it.
But how do you actually force a 13% margin company to suddenly operate at 27% without causing a massive operational revolt? That is a huge culture shock. Plus, combining IT systems and acquisitions is notoriously messy.
It is usually incredibly messy.
Yeah.
But Cintas is actually using this to avoid a massive cost. One of the reports noted that UniFirst was currently in the middle of a very expensive, clunky digital transformation.
Oh, boy.
Yeah, they were trying to roll out a new SAP enterprise system.
Which is painful.
Painful and costly.
Mm.
Cintas can just scrap that redundant implementation cost entirely by porting UniFirst's customers directly over to the proprietary systems Cintas has already built and paid for. It's cost avoidance from day one.
That makes a lot of sense. And they seem incredibly confident they can pull this off and that the government regulators will let them, because the sources highlight a specific clause in the merger agreement.
The break fee.
Yeah, a $350 million reverse break fee, and it's governed by a 10-month drop-dead timeline for regulatory close, meaning if regulators block this consolidation of the uniform market, or if it takes longer than 10 months to approve, Cintas has to pay UniFirst $350 million just for walking away.
That is a massive bet on regulatory
A
approval.
huge bet.
It's a textbook operational buyout.
Mm.
But as you noted earlier, they are paying a very steep premium for the privilege of taking on that integration risk. Which brings us to the elephant in the room regarding Cintas as a potential investment for you today.
Yeah, the market skepticism. We're talking about all this incredible execution, the hospital wins, the $375 million in synergies. But we have to talk about the price tag of the stock itself. The phrase that keeps appearing across our independent sources is priced for perfection.
Priced for perfection.
We've established that Cintas is an exceptional business, but the stock is currently trading at roughly 40 times forward earnings.
If we connect this to the bigger picture, a 40 times forward multiple is a valuation you typically only see applied to hypergrowth software and tech stocks. We're talking about companies that can scale globally with zero marginal cost.
Right. If a software company adds 1 million new users, it costs them almost nothing in physical resources.
Exactly. But Cintas is an industrial service provider. If they add 1 million new customers, they have to buy thousands of trucks, build dozens of industrial laundries, and hire an army of SSRs. Their 20-year historical average valuation multiple is around 25 times earnings.
So the market is paying an enormous premium right now compared to the company's own history. Why is that so dangerous?
Because at 40 times forward earnings, the market is pricing in zero room for error. The expected mid-double-digit growth is already fully baked into the current share price.
Which means there is absolutely no margin of safety for investors.
None. If Cintas stumbles even slightly, or if the broader market simply decides to normalize the multiple back toward that historical 25 times average,
The stock price drops.
it could suffer a severe compression,
Yeah.
even if the underlying business remains highly profitable.
And let's be real, perfection is impossible to maintain indefinitely. It isn't like Cintas is immune to internal operational headwinds. Let's talk about some of those stumbles because the sources highlight a few immediate internal risks. Specifically, Cintas is currently undergoing an SAP rollout of its own within its fire protection business.
Right.
And management expects that this implementation is going to create an estimated 100 basis points of margin drag going into fiscal year 2027.
So for you non-finance folks listening, 100 basis points means a full 1% hit to their profit margins. That might sound tiny, but when a stock is priced for perfection, a 1% stumble is a major red flag for institutional investors.
It's a big deal.
It's a necessary investment for their future scalability, sure.
Yeah.
But it's a very real short-term hit to their profitability metrics.
And when you're funding buybacks with commercial paper to keep EPS artificially high, a 1% margin hit suddenly matters a whole lot more.
It really does.
But let's look even further down the road, beyond next year's SAP rollout. The investigative reports brought up a fascinating existential risk that I hadn't even considered: the automation threat.
This is a critical point that really challenges the long-term durability of their moat. We praised Cintas earlier for their technological adoption, using software to optimize routes and scrub dispensers to lock in hospitals. But the lion's share of their actual physical services, sorting massive piles of dirty uniforms, loading industrial laundry machines, manually checking and restocking inventory cabinets, these are highly repetitive physical tasks.
They completely rely on human labor.
They do. And repetitive manual labor is the prime target for future disruption by robotics and artificial intelligence.
That makes total sense.
If a competitor, or even a well-funded new market entrant, can fully automate the sorting, cleaning, and dispensing processes using advanced robotics, they could fundamentally undercut Cintas's traditional labor-based cost structure.
Wow.
The very moat Cintas is built on human route density
Yeah.
and SSR relationships could eventually be threatened by autonomous systems that don't require hourly wages, health benefits, or sleep.
So, synthesizing all of this, what does it mean for someone looking at Cintas today? We have a brilliant business model, incredible current execution, a massive $5.5 billion strategic acquisition in UniFirst that promises huge synergies.
Right.
But we also have an eye-watering valuation, debt-funded buybacks, and looming long-term threats from automation.
When we pull all the findings from the analysts together, the verdict is that Cintas represents extreme quality at a severe premium. They are an elite compounder with exceptional management. They know exactly how to run their business.
Stock.
The stock price has simply become detached from the intrinsic fair value of the actual cash the business generates.
Right. The independent valuation models from our sources estimate that the true intrinsic value of the shares sits somewhere in the $160 to $171 range.
Which is significantly lower than where it's trading today.
Huh.
Because of that massive disconnect between the business's value and the stock's price, the consensus strategic outlook rating for the stock is a solid holdie.
Hold?
It's a phenomenal company, but it's just too expensive to justify buying at current levels.
Which brings us to why this deep dive is so important for you, the listener. This entire analysis is a masterclass in learning how to separate a truly great business from a great stock price.
Extremely important distinction.
It's incredibly easy to look at a company boasting record 23.4% margins, pulling off brilliant acquisitions, and dominating market share, and just assume it must be an incredible investment. But overpaying for perfection is a highly risky investment strategy. No matter how clean the uniforms are, or how incredibly dense the delivery routes get, if you buy with zero margin of safety at a 40 times multiple, you're leaving your portfolio exposed to the slightest shift in market sentiment or a single missed earnings target.
This raises an important question. We've spent this entire time unpacking how Cintas thrives on route density by physically visiting brick-and-mortar businesses. We've considered external threats like rival laundry companies, integration risks with UniFirst, and even advanced robotics replacing human sorters.
Right.
But what if the ultimate long-term threat is the ongoing virtualization of the economy itself?
Oh, that's an angle we haven't touched on yet.
Think about it. As more white-collar, administrative, and even some technical work goes permanently remote or virtual, the total footprint of physical office spaces and commercial facilities naturally reduces.
That's true.
If there are simply fewer physical buildings operating at full capacity to service, does the absolute ceiling for route density eventually start to shrink? How does a company built entirely on servicing the physical workday adapt if the physical workday itself begins to vanish?
That is a profound thought to chew on. Can a physical logistics empire pivot to a completely virtualized world? We'll leave you to ponder that one. Thank you for joining us today. Risk defined, portfolio protected.